Hello, everyone. Today on the final bar, we'll do our normal Friday routine, which is where we wrap the week. We focus on how the markets have evolved from last Friday to this Friday. We'll focus on the Mindful Investor Live ChartList, which I found is a great summary of the big picture using the key inputs of price, breadth, and sentiment. The S&P in the last couple of days, pretty choppy, accelerating to the upside into the close today, but I feel like I'm left wanting. You're not seeing dramatic pushing to the upside. We'll see what the charts can tell us today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets of the message of the markets themselves. We focus on price. Days like today with a sort of a V-shaped move with the sell-off in the first half, a rally into the close. What does that tell us about the overall big picture? Well, it tells us stocks are closing in a position of strength. That's encouraging. It tells you that buyers are coming in at some point and are pushing the price higher. It tells us we're at or near all-time highs. That's all encouraging. I was talking with my friend Tony Dwyer earlier today, who's been on the show before. He described his review today of the S&P charts as giving him further indigestion conviction or something like that, which is about how this feels. It is not an overwhelming, everything's great, thumbs up, clear upside type of market. And that's how I keep coming back to, it's not that things necessarily look bad. It's a question of limited upside. And I think when I look at the environment, I look at the choppiness, I look at the rotation, I feel more and more rotationary and less, if that's a word, and less, conviction of a big up move or a big down move from here. A lot of things continue to be range bound. And I think that's what we're going to have to continue to deal with for a little while here. We have great guests on the show. I was really happy this week with some of the conversations we had. Sam Burns yesterday was a lot of fun. Javed Mirza this week was really good. Next week, we have three good guests lined up for you. On Tuesday, June 15th, David Hunter. David's the Chief Macro Strategist at Contrarian Macro Advisors from in the New England area. On Wednesday, the 16th, Chris Shavako from Shavako Capital always does a great job looking at long-term analytics, long-term charts to put things in context. And then Thursday, Leslie Juflas from Trading Live Online. Leslie is a frequent guest host of Your Daily 5 on StockCharts TV, does a really, really good job. Also coming up next Tuesday, June 15th at 1 o'clock Eastern, I'll be doing my next webcast called Demystifying Fibonacci. We will talk about the Fibonacci numbers, the Fibonacci sequence, where they're from as a phenomenon, but most importantly, how we apply those relationships to the investment discipline. I'll show you examples of how they can be used. I'll share with you some examples of when I found them to work successfully, and we'll look at a number of current examples and apply Fibonacci real time to the markets. If you're interested in that free event, go to marketmisbehavior.com/Fibonacci to sign up. Let us wrap the week. I want to start with a poll. We always have a poll running on our StockCharts TV page on StockCharts.com/TV. That's where our live stream is running 24 hours a day, 7 days a week. We're also, of course, sharing that out via social media. The question was, what are you planning to do with your current investments in the stock market over the next 2 months ago? Choice one, continue to buy stocks, which was by far the most popular response. About 55% of you said that. Number two, hold stocks I own and don't buy. That was 28%. Sell stocks and take cash out of the market, 16%. So overall, sort of in order, continuing to buy, holding, and then only 16% of you selling. It's interesting. We don't do that question often enough to know what a normal response is. I wouldn't be surprised if on average that skews a little more positive. Questions like that, like do you tend to be buying or selling in general, barring some huge sell-off? In general, people tend to be more net buyers than sellers, and that makes sense if you look at what stocks have done over time. I mean, they tend to rise, and so being short the market, I've always told people you're fighting the major headwinds of the evolution of the equity markets over time. So you can short in the short term, but don't make it a long-term thing. That's not most likely not going to play out very well in your favor. However, 55% continuing to buy as the S&P is, at all-time highs. It shows you that there is participation. Again, when we look at the RIDEX flows, we see it at all-time lows, meaning that investors are overall sort of agreeing with you and are sort of all in, continuing to own stocks. Let's wrap the week here and look at very quickly. We'll look at what's happening in the market today, how the week closed off, and we'll spend a couple minutes on the wrap the week chart. This is where we look at just the weekly returns on the major asset classes. Then we'll get as quick as we can to the Mindful Investor Live ChartList, which is a systematic way every week of reviewing the major themes in play. Today, the S&P essentially closed up about 0.2%. Most of that came, to be honest, in the last 30 minutes of trading. So if you're looking for that last hour, last 30 minutes as a sign of overall sentiment, certainly stronger today than in the last couple of days. And most of the days this week, you actually distributed into the close. Today was more accumulation going into to the weekend. So the S&P new closing high 42.47 or so. If you look, mid caps and small caps pushing ever higher. So, today was a day when actually financials were the number one sector, followed by consumer discretionary and technology. So the small cap index up pretty good. That's a bit of a mean reversion play because financials have been struggling, really given rates coming down, the yield curve flattening. That's been worse, but a nice contrarian bounce higher in the small cap index. The VIX is back continuing below 16 right now. Looking at bond prices, a bit of a reversion back. We had an acceleration higher in the TLT, getting above 140 for the first time in quite a while, pulling off just a bit, 0.2% overall, and 10-year yields around 146. And again, that 1.5% level was a key support that we focused on, violated this week to the downside. Very quickly, elsewhere, precious metals down. Gold was down about 1.1%. Oil prices held in okay. Didn't really help energy stocks, which were down. And cryptocurrencies continue to be incredibly volatile, but Bitcoin chipping away, trying to push higher, is off a little bit from the high yesterday, but just back above 37,000. Ethereum, though, which a lot of people have looked at as outperforming Bitcoin recently, which is true, has really been at a pretty consistent downtrend here for the last 48 hours or so, down another 3% today. Let's look at the wrap the week chart. This is a chart that just focuses on the returns of the major asset classes in the last 5 trading days. We'll look at this together and then get to some other charts. Here in black there toward the bottom, we have the S&P 500, which spent by the end of this week up 0.4%, almost exactly in line with that was the US dollar, again, using the UUP as a proxy for the dollar index, up about 0.5%. What underperformed the S&P this week? Gold was actually down 0.8%, similar negative return on emerging markets, down about 0.8% as well. Everything else outperformed the S&P this week, starting with the NASDAQ 100, which was up 1.7%. Oil prices up 1.7%. Bonds up 1.7%. And then the best performers, small caps, up about 2.1%. We don't include Bitcoin on that chart. It actually is right in the middle of the pack this week. This is Bitcoin here, up about 1.1%. It skews the chart because it sold off pretty good there on Tuesday and Wednesday, but recovered pretty much all of those losses to finish with a gain for the week. So overall, I mean, not a huge dispersion, right, between these. I mean, overall, it was the S&P up a little bit, gold and precious metals, emerging markets down a little bit, everything else up a little bit more, but no dramatic outperformers, and cryptocurrencies were actually netted out to a fairly flat performance for the week. Let's get to the Mindful Investor Live ChartList. So as a reminder, this is where we like to spend a good amount of this segment every Friday. If you've not used this chart list before, you can actually get to it from our articles page. So if you go to the articles tab at the top of the StockCharts page, go to my blog, which is called The Mindful Investor. You'll see a link at the top in gray that says live chart list or something like that. You can click on that to access these charts that we're looking at. By the way, I just published about 40 minutes ago when we're recording this here Friday afternoon, an article basically talking about rates breaking down, bond prices breaking out, 3 charts to sort of follow those themes and track those trends and their implications for things like the financial sector, things like growth stocks and NASDAQ and others. So check that out on our articles page. Includes a video as well that I talk through some of those key charts and themes. All right, so looking at the Mindful Investor Live chart list, we start with the big picture, start with the market trend. This is the market trend model that I've been following for years. I created this a number of years ago when I was looking, trying to create a systematic model, not as a way to manage a portfolio or even manage my own investments. And so I don't think of it as an output. I don't do anything based purely on this model, but it's something that is an input in my process. I like systematic trend following models. I like screening for stocks breaking out and breaking down. That doesn't mean I would just blindly buy or sell any of those, but it points me in the right direction. It helps me understand the overall environment. So the market trend model looks like this. The long-term model remains positive, which it has been since last summer. That makes sense when we're at or near all-time highs. That's where the model should be. The medium-term model for me is more of the risk-on, risk-off side. That's what tells me overall to be looking for new, aggressive, long ideas to be trying to hit home runs, or do I want to be thinking more about risk? So should I be focusing more on return and potential upside, or risk and potential downside? It turned bearish about 4 weeks ago and has told me to remain cautious and be thinking more about the risk side of the equation. And what's been good about that is it's helped me recognize things like home builders, industrials, things like John Deere, financials starting to roll over a little bit, and recognizing when support levels are reached and when support levels are violated, and when trends evolve from accumulation phase to distribution phase. That's the essence of what this model is doing right now. And again, so it's telling me not to be too aggressive on the upside, to expect limited upside until this turns back positive, remaining negative today. The short-term model is really the tactical time frame. That's just telling you the very short-term read. Was this week positive or negative relative to the long-term trend? Positive again. It turned just the slightest bit negative about 4 weeks ago. And other than that, it's remained bullish for most of the last 3 months overall. And it's simply looking at where the price is relative to the 5-week exponential moving average. So short-term trend, the tactical trend really finishing in a position of strength this week. For me, the medium-term trend remaining weak, remaining bearish, tells me to be more cautious than optimistic in terms of potential next steps. The long-term model remains positive, which tells me overall allocating to equities has still been a very decent play, which is absolutely right. Let's look at the daily chart of the S&P as we've pushed to a new closing high today. Pretty strong finish to the week. And again, there's no denying that the trend is up. Talking with Sam Burns yesterday, we remembered Paul Montgomery's quote: the most bullish thing the market can do is go up. So if you find yourself questioning, are we in a bullish or bearish environment? How should I be positioned? Look at the chart. And if the chart is going up, then the trend is positive, and things overall are pretty good. And that's what I'm seeing looking at the daily chart of the S&P. We keep making higher highs. We recently have been making higher lows. That's all encouraging. I think the most important trend line on the planet is this one from the October low to the March low. That lines up with the 2 lows in May. And it's a little bit below where we're at, currently around 4,200, just below that. So if we would have a distribution next week, that would be the first line I would be looking at, and very closely related to that, the 50-day moving average, currently around 41.65 or so. And those two levels are pretty close. I think holding those levels on a pullback is what would tell you whether we're having a garden variety 4 to 5% pullback like we did here in May, like we did here in January, or if it's something deeper where you need to be a little more concerned. Things like last September, last October, even February into March, which again didn't end up being that horrible, that much worse than a 5% correction, but certainly put me on more of a defensive posturing, which I was okay with. I mean, I'm okay when the market is potentially breaking down. All large losses begin as small losses, and I'm okay being a little more cautious when that sort of pattern would break. I think the real line in the sand, though, would be S&P 40/50. That's the low from mid-May. Early May, holding that on a deeper pullback would be significant. It's about 5% below where we're closing today. Anything more than that, then you have to start thinking about the non-zero risk of going materially lower, and thinking about what lines in the sand you want to pay attention to with positions that you have with stocks and ETFs that you're owning. When you look at breadth, I would describe it as mixed. Overall, certain breadth measures very positive. The bullish percent index remains positive. The McClellan oscillator remains positive. The cumulative advanced decline lines, which we're looking at here, all very much positive. Large caps, mid caps, small caps, all making new highs again this week. It does not behoove us to be too negative when these advanced decline lines are going up, because that tells you that there's broad outperform. There's broad strength in the market. The average stock is doing just fine. When the market goes higher, when the S&P goes higher and these lines start to slope downwards, that's when you can start to be concerned about the length of an uptrend, or whether an uptrend is able to persist. At this point, not getting any signal there. New highs have been fine. I mean, I think yesterday, if you looked over the course of this week, on the average day, you had about 12 to 15% of the S&P making a new 52-week high. That's a pretty good number. That's sort of an average reading in a bullish phase. That's good. It's not the euphoric 40+% of the S&P is higher like you saw going into the May high. It's a little more measured than that, but overall, that's a good group of stocks, and it's a reminder that there are plenty of charts going up. And, you know, I read Investors Business Daily. I continue to have read that. I read that every weekend now, every Saturday. I used to read it every day when it was out early in my career. And it's been a great, as a stock picker, it's always been a really helpful way of making sense of the equity landscape. And what struck me always reading that paper every day is that there were always charts that looked kind of like the ideal William O'Neill growth chart, right? There were always them. There was no environment, even in really difficult market phases, where there weren't just some great examples of charts that were breaking out. And I think that's what this is a reminder of. There are charts like Facebook that are doing just fine, that are breaking out to new highs. And I would, as always, screen for those stocks and assume that those trends persist until proven otherwise. Where does the breadth get a little shadier? I would say this one is probably a good example. There's a bit of a divergence here over the course of the last 2 months, with the S&P pushing to new highs. The percent of stocks above their 200-day, robust, above 90%. That's very healthy. But if you look at the percent of stocks above their 50-day, it's continuing to decline. So every time we try to make new highs, there are less and less S&P stocks that have recovered their 50-day moving average. Out of anything I'm looking at, and I'm looking for causes for broad concern, that would be the one. If we have a dramatic sell-off in the next couple of weeks, I will probably look back at this as the clearest red flag that was there. Market going higher, but less and less S&P stocks regaining their 50-day. That shows you a little weakness under the hood that might not be reflected in the price of the S&P itself. We need to take a quick break. We'll be back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close for our show. We have a lot of fun putting this together for you every day. Enjoy bringing on some great guests. As a reminder, we'll do another mailbag segment for you here in a moment. We would love to answer one of your questions. On next week's show, we'll do another mailbag segment on Tuesday. Shoot us an email with any questions that are coming up as you are analyzing your own charts. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching. We would love to hear from you and hope to answer one of your questions in our next mailbag segment. Also, as a reminder, StockCharts TV on demand is really, really well done. I'm super proud of our team, not just for the great content we're putting out, but how well they designed an app that elevates that content and brings it to life in a very interactive and effective way. Go to stockchartstv.com to use your email and set up a free account. Start watching content immediately. We're also on all the app stores. Just search for StockCharts TV on demand. Next, we're going to answer your questions from the Final Bar Mailbag. We've received so many great questions recently, and we very much appreciate the opportunity to help educate and inspire and inform and hopefully point you in the right direction in your own process. Let's get to the questions. Question number one, may I request a short education lesson on the logic of 2-year versus 10-year? So yes, and I will tell you, this is going to be the short 30-second version, just because with the mailbag, we only have so much we can do. If you don't understand it very well, on my YouTube channel just this week, I posted a video focused on the 2s versus 10s and the shape of the yield curve and what that means. My YouTube channel is called Market Misbehavior. Go check it out there, and hopefully that will help fill in some of the blanks for you. But the short way I would summarize it is this. When you're looking at interest rates, you're looking at the shape of the yield curve. The best way to see that, by the way, is on StockCharts. Go to Charts and Tools, and on the right, there's a link that says Dynamic Yield Curve. This is such a cool, very simple, but very effective illustration of the relationship between the yield curve and the equity markets. On the right, we have a chart of the S&P 500. You can click your left mouse and drag it to focus on any point in the last 20 odd years. On the left, you're looking at the yield curve. This is basically the interest rate that you're receiving by owning a 3-month treasury bill all the way out to a 30-year treasury bond and everything in between. This is called the yield curve. The short end is down here a couple months. The long end is down here many, many years. The shape of the yield curve is how essentially a bank makes money borrowing at the short end and lending money to you to buy a house or a car at the long end. And the steeper the curve, generally speaking, the better it is for a financial institution because it's easier for them to make money. They can still do fine in other environments, of course, but this is definitely more of a tailwind when the yield curve is steeper. So what I'm doing with the chart here is showing you the difference between the 10-year yield minus the 2-year yield. So if this is going up, the yield curve overall is steepening on that last page. If the line is going down, the ratio or the spread is going down, that means that the yield curve is flattening, which means in general, it is either getting easier for banks to make money. You see here where the financial sector is outperforming, where the yield curve is steepening, or the yield curve is tightening, and you can see that financials start to underperform during those environments. First quarter of 2020 maybe is a good illustration of that. That is the summary of 2s versus 10s. And on the institutional side, that's a common way we would use to measure the shape of the yield curve because it has implications for a lot of things, not just banks, by the way, but also consumers, right? If it's easier or cheaper to borrow money, you're much more likely as a consumer to spend money and to take on debt. Next question, boy, this is a meaty one, so let's jump to a couple of these. Yeah, I was intrigued by your guest this week showing high vol and the S&P high beta and low vol charts. If we have to mimic those in stock charts, how can we do that? Yeah, really good question. Sam Burns, I want to say, is one who showed that yesterday. Was the high beta versus low vol ratio. So I have a chart list called ratios, which we look at sometimes. I have a chart on here called high beta versus low vol, and it's pretty simple. It's just the ratio between two ETFs, SPHB and SPLV. These are the S&P 500 high beta and low vol ETFs. You can look up the holdings on like ETF.com if you want and look at the types of stocks that are in there, but basically higher beta, more higher volatility, more riskier names. Low volatility are things that tend to have a lower volatility, tend to have a lower trading range, lower relative movement in general. So it's sort of like the risky stuff versus the less risky stuff is that ratio. But those are the two ETFs that I tend to use. They're relatively low cost and match the indexes that they're based off of pretty well. But that's what I would use to track that ratio. And you can look at the holdings to understand a little bit more about how they're created. Next question, I was looking to add QYLD, which I'll be honest, I've never seen before, I don't think. So let's bring that up. A Global X NASDAQ 100 covered call ETF. That's fascinating. I will dig into that more. I'm not super familiar with that. I went to StockCharts, saw that the chart was basically up and thought that was great. Got a nice dividend and some capital appreciation. I then read some research that said the stock was basically losing value over time, which did not match my view of the chart. And you asked about the adjusted versus unadjusted data. Let's bring that up and unadjusted here. And we'll probably see what you're, I'm sure we'll see what you're suggesting because the yield's so high. So here's what's happening here. When StockCharts.com was in its infancy and Chip Anderson created this beautiful website and worked with John Murphy to just think about how we can stay true to the essence of technical analysis. When you're looking at data, you have to think about whether you're adjusting price data or not. And what happens is something like this is paying a huge dividend. And I don't know if that's monthly or quarterly or whatever, but a stock like AT&T or something and other names pay big dividends. REITs pay big dividends. Utilities pay decent dividends. And what happens is on a normal price chart, now that we're unadjusting, what happens is when that dividend happens, the entire data series comes down because basically you take the value of the dividend out of the price of the stock. So if you're just drawing by hand and analyzing a price chart every day, it's going to look like this. This is what your hand-drawn chart would look like because you're basically showing where the stock or the ETF traded at any given moment going back over time. The problem with that, though, is it has all these artificial gaps, which will affect something like RSI. And if you want RSI and other indicators to measure price momentum, to measure investor behavior, you're getting this artificial dip every time the stock pays a dividend. It's not a great way of actually measuring behavior. So what StockCharts does by default is it just adjusts the data, which means when a dividend is paid out, you adjust all the historical series and basically bump it up a little bit so that it looks more relevant, right? So that it looks more representative of the current. So actually, sorry, you bring it down so it would match the current prices, right? So going back, it looks a little worse. So what happens is if you bring up QYLD or the chart of AT&T or Verizon, look at a longer term chart, you will find that they look much better when you adjust the data versus when you put the little underscore, which basically takes all the dividends and splits and other things, by the way, out of the data series. So if you're trying to understand the long-term return profile, or if you're trying to use technical indicators and measure momentum, you want to adjust the data. If you're looking purely at price, support, and resistance, you would do it on price. So how do you account for dividends? So a lot of times when I've unadjusted the data, you just think of the dividend yield as an input, but as a separate input. You're looking at price and investor decision-making as one piece. You think about the dividend component, the total return as a separate thought process, and that's how you do it. So that is why your chart looks very different, and that is the very good reason why that makes sense. Let's see. Great content for your show on Friday. Out of the zillion lists you have to determine market conditions and sentiment, and that's so true. I have to simplify. It's on my wish list. If you have to force yourself to choose 10 or max 15 charts or breadth indicators, which ones would you choose? It is a really good question. The reason why I set up this Mindful Investor Live ChartList was I was talking with Grayson Rose when I joined StockCharts full time a year and a half, almost 2 years ago now. Wow. And I was looking at, how I was using stock charts and how I could illustrate my process to our viewers and our readers and members. And I came up with this Mindful Investor Live chart list. And this is basically the charts that I look at all the time in one chart list. And it's about 20 charts. So if you had me pick 10, I would probably pick the first 10, because after the second half gets into more ratios and things that I think are more interesting and help you understand the dynamics. But the first 10 really cover price and breadth and sentiment for equities. What it doesn't cover necessarily are other asset classes, things like crude oil and interest rates and the dollar, which I think are important. But if I want to understand breadth and everything, that's what I would use. Great questions all around, guys. Thank you as always for sending in thoughtful questions, for sharing your charts, and I appreciate the opportunity to help point you in the right direction. We need to go the 3 and 3 charts in 3 minutes. Here we go to wrap the week. Chart number 1. I actually used this during the mailbag because I thought it would be a great way to answer that question about 2s versus 10s, and we'll start here. The yield curve, the yield curve flattening, interest rates coming off on the long end, bond prices going up, I would argue is one of the biggest indications this week that we saw, because it has a lot of ripple effects for financial stocks, for value stocks, for growth stocks. This is the chart I'm going to use to track that. The yield curve flattening, rates coming down, would most likely be negative for the performance of financials and positive for growth areas like the Qs. If that plays out as you would expect, the green line should most likely go up, meaning the Qs are outperforming the S&P, and the line on top should be going down, saying that the financial sector is underperforming. Speaking of financial stocks underperforming, you're starting to see some weakness in charts like Huntington Bank shares. That'll be chart number 2 for us today. Not broken yet. It's sort of testing support, testing the lows from April. But so far, we put in a lower high, and now we're potentially putting in a lower low. You've already seen that breakdown, by the way, on 2 other charts we featured in our 3 and 3 this week. John Deere earlier this week, breaking down through support, breaking down through the 50-day. Yesterday, we looked at a home builder, I forget which one, Lennar or DR Horton, if I remember right, and looked at how that had broken down through support. Huntington Bank shares, some of the regional banks, very close to doing so as well. So you're seeing this rotation away from the value-y stuff and potentially into the growthy stuff, and that's a theme that I think could potentially go into next week and beyond. That brings us to chart number 3, which is the NASDAQ composite. The NASDAQ 100, NASDAQ composite, similar ranges in terms of the value of the index, and they're right around that 14,000 level. The NASDAQ composite is once again at this high. It was at the high in February, retested around just above 14,000 at the end of April. Now, once again, at those same exact levels. Here's the advanced decline line for the NASDAQ, by the way. While all the other ones that we looked at are at new highs, this one is still below its February high. The NASDAQ breaking out to the upside and breaking to new highs on the advanced decline line would be a key indication of the return of the leadership of growth. Folks, that's our show for today, and a wrap for this week on the Final Bar. Thanks so much for joining us every weekday for our show as we break down the key charts of the day. As a reminder, keep your questions coming. The Final Bar at StockCharts.com is our email. We'd love to answer your questions next week. In closing, today's my wife's birthday. Happy birthday, Carrie. Can't wait to celebrate it here shortly. From everyone at StockCharts TV, I'm Dave Keller. Have a great weekend. Be safe. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.